Assalamu alaikum everyone. This video is about how central banks create reserves, and to create this video I've relied on the example provided by Positive Money on their website. So before we look at the actual mechanism by which the reserves are created, let's have an understanding of the fundamentals. So from the monetary economic perspective, we have a central bank and then we have commercial banks. And these commercial banks have depositors and customers. And these customers and depositors are people like John, Salman, Sachin, and so on and so forth. So these people, these customers, have their accounts in the commercial banks. So they could either keep the money in the current accounts or the checking account, and then basically they use their debit cards to withdraw that cash, or they could keep their money in savings account or in time deposit accounts on which they earn interest. So these are the two kinds of accounts that customers have in commercial banks. Now let's look at the central bank. What is a central bank? Central bank is a bank of banks, i.e., just like banks have customers like John and Salman, similarly the central bank has customers, and these customers are the commercial banks. So think in this way. The customers of the central bank are the Royal Bank of Scotland, HSBC, and so on and so forth. So there are multiple commercial banks which are the customers of the central bank. Now, just as commercial banks have a current account and savings accounts, similarly the central bank also has a current account and a savings account. So in the context of a central bank, a current account is called as a reserves account. So the money which the customers deposit in the central bank, that money is called as reserves. Okay, and that's equivalent to a current account, which can be withdrawn just like cash, or when we withdraw money from the ATM machines. Similarly, the commercial banks, which are the customers of the central bank, could also deposit their money in the savings account, and the savings account in the context of central banks is the government bonds and gilts and T-bills and so on and so forth. So think in this way, and a lot of the monetary economics will start making sense. So just to recap this slide, commercial banks have customers, which are the individuals and companies in the private sector. Similarly, the central bank has customers, but the customers of the central banks are the commercial banks. Commercial banks have current accounts and savings accounts. Similarly, the central banks have current accounts and savings accounts. So with this context, the forthcoming slides will be easy to understand. So let's take the example of the case of the United Kingdom, where the central bank is the Bank of England. So on the left hand side, you see the balance sheet of the Bank of England, which is the central bank of the UK, and on the right hand side you have the balance sheet of one of the commercial banks, which is the Royal Bank of Scotland, which is RBS. So in all the upcoming slides, on the left hand side is the central bank, and on the right hand side is a commercial bank. So think in that way. So let's start by seeing how Bank of England creates the electronic money that banks use to make payments to other commercial banks. So the central bank reserves are one of the three types of money and are created by the central bank in order to facilitate payments between commercial banks. So in this example, let's start with the right hand side. So let's assume the shareholders of the Royal Bank of Scotland, they establish a new bank, the Royal Bank of Scotland, and they put up £10,000 of their own money as equity capital of the bank, and then they use this money to buy the government bonds, which is the gilts. So accordingly, we have £10,000 on the liability side, which is the shareholders' equity, and on the asset side, we have the gilts as assets, which will give interest income to the shareholders. And let's assume, for the sake of simplicity, that there are no assets or liabilities at the central bank in the step one. So let's say in this step, the Royal Bank of Scotland needs money and it needs to convert their gilts into reserves. Recall that reserves are nothing but cash which the commercial banks need to settle transactions with other banks. So the RBS contacts the central bank, the Bank of England, and informs them that they would like £10,000 as reserves. So essentially what they want to do is they want to convert their gilts into liquid reserves. So what happens is the Bank of England purchases the gilts from RBS, and once the sale is completed, the Bank of England has gained £10,000 of gilts as an asset, and it also has a liability of £10,000 as reserves. Now recall that originally the Bank of England had 0 assets and 0 liabilities, and the RBS had gilts worth £10,000. So on the right hand side, nothing has changed. One asset has been swapped with another, so £10,000 worth of gilts have been converted into liquid reserves of £10,000, which the RBS can use to create more loans and settle transactions with other banks. However, on the left hand side, the central bank's balance sheet has expanded. So the Bank of England has purchased this government bond for £10,000. And where did the money come from? So this money has been created from nothing, and through keystrokes, the Bank of England has injected reserves into the current account of the RBS, and that's how the purchase of the government bonds has been funded. So we said in the previous slide that the RBS needs liquid reserves, and we said one way for RBS to get the reserves would be to convert the gilts into reserves, i.e. liquid cash. However, there is another way. The RBS could borrow from the central bank, and the mechanics would be as follows. So recall that the central bank had 0 assets and 0 liabilities, and then of course in the previous slide we did not have these 2 entries as well. So the central bank creates a loan to RBS through keystrokes, and it also creates reserves, liquid reserves, i.e. in the current account of the RBS. It puts in money which can be used to create more loans or settle transactions. And this is of course happening through keystrokes. It's not through tax money, it's not through gold reserves, it's just happening through keystrokes. And conversely, on the side of the RBS, they would now have central bank reserves of £10,000, which they can use to create more loans. And they also have a liability, which is to repay its dues to the central bank in the future. So thank you very much. I hope you found the video useful. If you have any questions or comments, please let me know in the comment section below.